Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of Chicago wheat, Chicago corn, and Kansas City wheat. Chicago wheat. Since late March, possibly even mid-February, two patterns have tried to catch the mood of this market, and they continue to frustrate the hell out of me right now. The first was the previously mentioned mid-February to early May pink descending triangle pattern type, which we have finished with back in early May. It's not a perfect pattern by any means, however the pink upper trend line, though previously breached, did show some merit, and the flatlining, flattish pink lower trend line did hold up the market for a while, though it gave way in late April. Yeah, with changeover, I've been forced to rethink this once more. More on this shortly. The second pattern utilises the pink lower trend line, but instead it's a smaller pattern and dates from mid-March and has a bright red upper trend line on my daily chart. This had a break on the downside at the end of April, but with changeover, prices have found themselves initially back within the descending triangle and then 3 weeks ago back out again, but this time breaking higher out of it. The key on the downside is the support seen by the 38.2% absolute Fibonacci at 521. More recently, the purple neckline, currently 537.5 of the February to April 24 reverse head and shoulders pattern, plus the December 2020 low at 566. Along with the flatlining mauve medium moving average, currently 559, especially the flatlining gold long moving average, currently 568. Now this gold long moving average that's above the market is where prices became bogged down weeks ago, even this week, the end of last week and the beginning of this week. And please bear in mind that beyond these we have some clean air up until the congestion at 588 and the March 21 low at 592. Overall, this has been the second break from these triangles, and I still have some small belief, even now, as far as I've said now, and it's something I've said now for 3 weeks, and I quote, that having advanced so far along these patterns that we might be handed here a double bluff with now a second possible false break, this time higher, end of quote. Which is what turned out to be the truth. That all being said, this week has left us with 3 potential Easter eggs, as in opportunities and not necessarily the chocolate ones. The immediate one is that we are set up this week for a weekly key reversal. Thus, if we close tonight either over 568 3/4 or under 548 1/4, well then we'd be on. Anything in between and would be a lesser outside week. Now, this is quite a large range to get outside, but right now we are looking at a weekly key reversal down. The second feature is we have a mid-May to date double top, with prices right now pushing below the approximate neckline for this. And I'm using the September low at 539 3/4 as a proxy. Now, we've pushed down below this today, but we've not as yet managed to close below it. But just in case we do, by the next time I discuss Chicago wheat, then here are some potentials below. We have a primary potential down in the 524 zone and a secondary harder to reach potential down in the 511 zone. Now the primary potential is just ahead of the 38.2% absolute Fibonacci line at 521, and the second potential is close to the, well, it's close to the recent lows. The third feature is the largest, and it is to look at the whole mid-March to date action as a possible reverse head and shoulders pattern. Typically this is seen as a bullish reversal pattern, but head and shoulders continuation patterns also exist. So I would delay any opinion on which one until I have some further data. The neckline for this, well, I'd use the crucial gold long moving average right now until we see further developments. Chicago corn. 4 weeks ago I drew a mid-February to mid-April bearish Andrews picture, which, whilst not being exact as the upper time, currently 411, had been breached on a number of occasions, most recently last week, it still nevertheless showed for quite a while the bearish angle of attack. I originally chose the steeper bearish Andrews pitch hook over the shallower bearish shift pitch hook because I thought it'd give a more suitable representation of the way the market was moving lower, which it did. However, and it is an important however, and I quote from 2 weeks ago when I said, however, that being said, the time's next crossover this coming Monday, the 19th of May, so watch for one or more of the following then. A change in trend, a reinforcement of a trend, volatility. Coincidentally, after changeover this week, that's last week, more than that, some while back now, prices are now testing the 50% absolute Fibonacci line at 425, so it's worth being cautious right now, end of quote. Well, that caution was well rewarded, as on Monday the 19th we had a combined key reversal up, if only just, plus a bullish engulfing pattern and a bullish opening white Mariboso, leading to prices rising up in the early part of 3 weeks ago, filling in the changeover gap and thus fully justifying the earlier time crossover warning I'd given. Now last week, with the break above the upper time, I had been inspired to fully draw the shallower bearish shift pitch hook with the same move as the bearish Andrews one, as a transition from the steeper Andrews to the shallower shift pitch hook. Thus right now we are in between the overhead middle time, currently at 437, and the lower time, currently at 402. Now the next obstacle topside is the November 2020 high at 439. While looking below, well, the immediate 50% absolute Fibonacci line at 425 we had last year, below the immediate 50% absolute Fibonacci line at 425, we have the December 2020 low at 414, which ties in the low of late November last year. Support is then fairly evenly spaced out at 409, 403 until the November 2020 low at 397. And that is just about as far as I'd like to go before I once more review the market action, should we manage to get down that far. There are a couple of things I would like to mention. The first ties in with the earlier crossover of times back on the 19th of May. The next crossover, indeed, the last and consequently the least powerful, will happen on the 24th of June. Now I've highlighted this with a bright red circle just above the picture of me on the screen. I'm pointing to it now. Excuse me. Be wary then, just in case of a possible change in trend, or a reinforcement of a trend, and of course volatility, or all three at the same time. The second and final point is that we are set up today for this week to be a weekly key reversal, if only just, as we have matching lows at 419 and a quarter for the past 2 weeks. Thus, if we close tonight either over 433 and a quarter or under 423 and a quarter, then we'd be on. Anything in between and would have a lesser outside weak pattern. It should be no surprise to you, with such a large range, that we are looking right now at a lesser outside weak pattern, though towards the lower end. That being said, we still have quite a few hours of today to look at this idea. Kansas City wheat. Since mid-February, 2 major patterns have developed here, one of which is still live, and a third that is no longer operational, but from which we have some echoes that resonate even today. The first pattern is a mid-February to late April sideways triangle, made up from the bright pink uptrend and the bright red downtrend. It's not a great looking pattern by any means, but it nevertheless still exists. And 7 weeks ago, prices pushed down below the pink lower trend line, whilst at the same time following on lower from a mid-March to early May bearish halfway hesitation pattern. The second pattern is a dark blue February to March bearish shift pitch hook, with prices still live within this pattern. 4 weeks ago, we saw the market test the lower time, currently at 491, piercing it, but reverting back upwards almost immediately, prompted in part by the previously highlighted unreconstructed December 1999 to date uptrend that was nearby, currently at 504, happening just before changeover. Over the past 4 weeks, prices have pierced and started resting on top of the middle time, currently at 538, and for a while early on top of the March 24 low at 551. They pushed up as far as the March 21 low at 559, but started to get capped by the green short medium moving average, currently at 550. Though last week the market started pushing up through the green short medium moving average, this week we have a dramatic reversion back down, which has created a new pattern that I will detail shortly. Finally, 6 weeks ago prices broke down through the the now unhighlighted lower time, currently at 551, of the significant and very shallow late August to early December 2024 bullish shift pitch hook, one I was considering retiring. I've kept it on these past few weeks. Prices have moved for a little while and we'll come back. I've kept it on as these past few weeks prices have moved for a little while, and we'll come back to that shortly, back over the broken lower time. You can just about see it on my daily chart. Okay, so going back to the first pattern again of the sideways triangle, I said 6 weeks ago, and I quote, all this action has nevertheless still left us with some targets below for the sideways triangle pattern type. We have a primary target X in the 522 zone, not too far away, and a secondary hard to reach target X1 down in the 471 zone. I'm not too sure about these two, but for now they will do, end of quote. Primary target X did very nicely, being achieved soon after my video back then, but last week I spoke about retiring the harder secondary target X1, as it has recently had a figurative question mark placed over it. Well, I have changed my mind on this, and there are 2 new features this week, possibly even 3 new features this week that made me recant my opinion, at least for now. Firstly, and most immediately, we are set up for a weekly key reversal for this week. Thus, if we close tonight either over 562.5 or under 547 even, then we'd be on. Anything in between would give us a lesser outside week pattern. Right now we are just within the weekly key reversal down zone. Barely. Secondly, we have a mid-May to date double top pattern, Adam and Eve type. Now, some could say it is a triple top, and I would understand that, but I still favour the double top, Adam and Eve type. We have a neckline at about 537.5, but I personally wouldn't value it happening unless we had confirmed closes below the 38.2% absolute Fibonacci line at 533. Thus, we do not as yet have targets, but we do have potentials. A primary potential will be down in the 518 zone, whilst a secondary, harder to reach potential will be down in the 505.5 zone. It's noticeable that the secondary potential is down on the unreconstructed 1999 to date uptrend. Finally, and this may or may not be happening here, is a late April to early June small reverse head and shoulders pattern. I am not too keen on this, as it requires a good deal of optimization, so I haven't marked it. Now, I am not against optimization of trend lines and patterns, but given the small size of this one, I think it's a bit of a stretch, so I'll reserve my opinion on it for now. Thank you for listening and watching this broadcast. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. The copyright is Eddie Tofpick and ADM Investor Services International Limited. And here comes the final important bit.